Welcome to the video. Today we'll clear up a costly misconception, mixing up IRA contribution limits with tax deduction limits. We will explain how traditional and Roth IRAs share a single contribution cap, how employer plans like 401ks have their own separate caps, and why deductibility, not your ability to contribute, is where workplace plan coverage matters for traditional IRAs. We'll also cover Roth IRA income limits and the backdoor Roth strategy. Let's dive in. Here's our roadmap. First, we'll tackle the big myth. Next, we'll separate contribution limits from deduction limits. Then, we'll explain traditional IRA deductibility phaseouts, followed by Roth IRA income limits and the backdoor Roth. After that, we'll walk through examples and an action checklist. Finally, we'll test your knowledge with a quick quiz, summarize key takeaways, and wrap up. Before we start, a quick disclaimer. This content is for educational purposes only and should not be considered tax, legal, or investment advice. Please consult a qualified professional for guidance tailored to your situation, and always verify current IRS rules and phase-out ranges, which can change annually. Let's address the myth head-on. Many people believe that participating in a 401k limits how much they can contribute to an IRA. That's not accurate. Your workplace plan can affect whether a traditional IRA contribution is deductible on your taxes, but it does not limit your ability to contribute to an IRA up to the annual cap. Now, let's clarify how the contribution limits actually work. First, understand that your IRA limit is a single annual cap shared between traditional and Roth IRAs. For example, if the limit is $7,000 for those under 50, any contribution you make to a Roth IRA reduces the amount you can contribute to a traditional IRA in the same year, and vice versa. However, this IRA cap is completely independent from the contribution limits on employer-sponsored plans like 401ks, 403b, or 457 plans. Those plans have their own, generally higher, contribution limits, and they do not reduce your IRA contribution space. This is the crucial separation. IRAs share a cap only with each other, not with workplace plans. Next, this flowchart illustrates traditional IRA deductibility. Start by checking whether you are covered by a workplace retirement plan. If you are not covered, your traditional IRA is generally deductible up to the annual limit, assuming no other unusual circumstances. If you are covered, deductibility depends on your tax filing status and your modified adjusted gross income relative to the IRS phase-out ranges. If your MAGI is below the range, you get a full deduction. If it is within the range, you receive a partial deduction. If it is above the range, you have no deduction and your contribution becomes non-deductible. Note that this impacts taxes only. It does not change your ability to contribute. Always confirm the latest IRS phase-out thresholds. Now, the trap. If you or your spouse are covered by a workplace plan and your modified adjusted gross income is high, your traditional IRA deduction may be reduced or eliminated by phase-outs. Importantly, you can still contribute up to the full IRA amount, but your contribution may be non-deductible. Non-deductible contributions create basis that must be tracked on IRS Form 8606 to avoid double taxation. The key misconception is believing that losing the deduction means you cannot contribute. That is incorrect. You can contribute, you just might not get an immediate tax deduction. Therefore, always check the current IRS phase-out ranges before you file. Let's compare contribution limits and deduction limits. On the left, the contribution limit is the annual dollar cap shared only between traditional and Roth IRAs. It is completely separate from workplace plan limits. It dictates how many dollars you can put into IRAs in total. On the right, the deduction limit is about tax treatment. It is affected by whether you or your spouse are covered by a workplace plan, and your MAGI varies by filing status, and it determines whether your traditional IRA contribution is deductible, partially deductible, or non-deductible. It does not limit your ability to contribute. Moving on, this mind map outlines Roth IRA access. If your MAGI is under the IRS threshold for your filing status, you can contribute directly to a Roth IRA, subject to annual contribution limits. If your income is above the threshold, you cannot contribute directly. Instead, the backdoor Roth IRA path becomes relevant. That involves making a non-deductible contribution to a traditional IRA, tracking the basis on Form 8606, and promptly converting to a Roth IRA. Be very cautious about the pro rata rule if you have existing pre-tax IRA balances. because it can cause part of the conversion to be taxable. Always verify the current IRS income thresholds, as they can change year to year. Next, let's walk through the backdoor Roth steps. First, open or confirm you have a traditional IRA. Second, contribute non-deductible dollars up to your IRA annual cap. Third, document your basis on IRS Form 8606 so it is tracked correctly. Fourth, convert the funds to a Roth IRA promptly to minimize taxable earnings. Fifth, try to avoid having large existing pre-tax IRA balances to reduce pro rata rule complications. Finally, file correctly by reporting both the contribution and the conversion on Form 8606. This sequence ensures a clean backdoor Roth implementation. To recap in a quick Markdown-style summary. First, IRAs share contribution space only between traditional and Roth, not with workplace plans. Second, workplace plan participation does not reduce IRA contribution space. Third, deductibility is separate and depends on coverage and MAGI. For watchouts, non-deductible contributions require careful Form 8606 basis tracking. Roth IRAs have income cliffs, so consider the backdoor Roth if you are over the limit. And always verify current IRS thresholds since they change over time. Let's make this practical with simplified scenarios. First, Alex is single, covered by a workplace plan, with a $65,000 MAGI. Alex may receive a full or partial traditional IRA deduction depending on the current single filer phase-out range. Second, Blake and Casey file jointly, both are covered, and their combined MAGI is $245,000. Likely above the Roth direct contribution limit. They might consider a backdoor Roth. Their traditional IRA contributions would be non-deductible at that income if covered. They must watch the pro rata rule. Third, Devin files jointly where only the spouse is covered by a workplace plan and their MAGI is $140,000. The non-covered spouse may still qualify for a traditional IRA deduction. Exact eligibility depends on the MFJ phase-out ranges for the spouse coverage situation. Always check current IRS tables. Quiz time. Question: does participating in a 401k reduce how much you can contribute to your IRAs this year? Option A: yes, it reduces your IRA contribution dollar limit. Option B: no, IRA contribution limits are separate from 401k limits. Option C: only if you also have a Roth 401k. Option D: only if your MAGI is above the Roth threshold. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. IRA contribution limits are separate from 401k limits. Participation in a workplace plan does not reduce the number of dollars you can contribute to IRAs. The employer plan only affects deductibility for traditional IRAs when combined with your income and filing status. Second quiz question: what primarily determines whether a traditional IRA contribution is deductible if you are covered by a workplace plan? Option A: your age only. Option B: your MAGI and filing status relative to IRS phase-out ranges. Option C: whether you also have a Roth IRA. Option D: how much you contributed to your 401k. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. If you are covered by a workplace plan, deductibility depends on your modified adjusted gross income and your filing status relative to the IRS phase-out ranges. Your age, having a Roth IRA, or the specific amount you contributed to your 401k do not directly determine traditional IRA deductibility. Here is your action checklist. First, confirm your IRA contribution cap and decide how to allocate between traditional and Roth. Second, ignore 401k limits when planning IRA contribution amounts because they are separate. Third, if you are covered at work, check the IRS MAGI phase-out ranges to determine traditional IRA deductibility. Fourth, if you are over the Roth income limit, consider the backdoor Roth, but be careful with the pro rata rule. Fifth, track non-deductible basis on Form 8606 to prevent double taxation. Finally, revisit all of this annually since thresholds and limits change. To summarize, first, IRAs share a single annual cap between traditional and Roth IRAs, and this cap is not shared with 401ks. Second, deductibility is a separate issue determined by whether you or your spouse are covered by a workplace plan and your modified adjusted gross income. Third, Roth IRAs impose income cliffs, and the backdoor Roth can be a viable strategy for high earners, provided you manage the pro rata rule and handle Form 8606 correctly. Finally, always verify current IRS tables to avoid unexpected tax outcomes. Thanks for watching. If this clarified the difference between IRA contribution limits and deductions, please like the video, share it with someone who needs it, and subscribe for more smart money content. Post your questions and insights in the comments. I would love to hear your thoughts and help you avoid costly mistakes.